Permanent housing markets. The permanent housing market is a cooperative financial system that replaces traditional individual mortgage arrangements. In this example, it assumes 5 households with homes of equal value and compares the PHM model to conventional bank loans. The model implements the efficient capitalization hypothesis, which is available on a YouTube with a link in the description of this YouTube, that explains how community banks can reduce costs and increase returns by eliminating the capitalization of interest. Essentially, the PHM model asks banks to stop adding interest to the principal loan amount. Households with mortgages. All occupiers have the same income. All houses cost the same. Some have mortgages, some don't. Each household earns $80,000 after tax. House prices are all $820,000 each. One house is owned outright. One house is rented at $59,000 per year, which is the cost of the mortgage. The 3 are mortgaged at 6% over 30 years. And the total mortgage costs are $154,887 per year. Removing interest capitalisation. Cooperative is formed and receives a non-capitalised loan, nearly $2 million, from a community bank banked by a total asset value of $4.1 million. The funds are used to buy the rented properties, pay off all outstanding loans. The houses become cooperative-owned assets represented by shares. Ownership is shared among members who hold shares and traditional titles. The key features of the cooperative. The community bank ensures that the loan remains with the PHM system by requiring each member and the PHM to have accounts with the bank. The bank and investors receive an indexed annual return of 6%. Members contribute 25% of their income with flexibility to contribute more or less. One member, one vote, governance structures. What happens? The financial comparison between the two systems is pretty stark. Under the PHM, all of the money members pay builds their equity. Under bank loans, typically half the payments benefit shareholders through capital gains. In a PHM, bank profit is maintained and increased, but unearned capital gains are diverted to community ownership. So, the capital gains that the bank now keeps for its shareholders is transferred to the community members buying the houses, which is only fair. Some suggested cooperative rules. Well, we have needs-based allocation. Entry is based on need as defined by government community regulations rather than the ability to outbid others. Equal exchange value. Members receive equal value for equal payments. Seems reasonable. Insurance. Instead of traditional insurance, losses are replaced by new loans, with members forfeiting their related equity. Private insurance remains optional. Property management. The cooperative oversees maintenance, renovations and extension decisions. Property values adjust based on actual improvements, not the amount spent. Mobility. Members can transfer to other cooperatives or exit the system with minimal fees. There are broader implications of this approach. The model can be applied to any long-lasting asset, not just housing. It does not significantly alter the day-to-day operations for occupiers or users of the assets, but it shifts ownership and value from the wealthy to the community. YouTubes on other asset classes are being prepared, including solar panels, community bank batteries, funding footpaths, an art gallery, publicity, public transport, water supplies, electricity transmission and distribution, toll roads, research and development, education, the list goes on. The next video in this series will describe how the approach prevents inflation and allows a central bank to control the money supply without changing interest rates. Thanks for listening.